Berkshire Hathaway owns 400 million shares of Coca-Cola. It paid $1.3 billion for them, finishing in 1994. Last year, that one position paid out $816 million in dividends, 63 cents a year, every year for every dollar it originally put in. That's the greatest dividend snowball anyone has ever built, and it's still lost to an index fund. So I ran the math on all of it. Here's what it takes, where it breaks, and how to build the version that works. Snowball. We're going to talk about the honest math behind the strategy that everybody talks about in the community and give you an overview of how you can use a dividend snowball to grow your wealth. So there could be three things true at once. So the snowball is real math. It is far slower than advertised. You'll see a lot of people talk about 1,000 to 100,000 in 20 years. That's unfortunately wrong. And most of the proof points are wrong. So this actually is a great thing, but it started a little bit off. And we'll talk about that. So the metaphor that we talk about with the dividend snowball is actually borrowed. Most people don't know that. So here is the quote that everybody uses. This is from the Snowball book that Alex Schroeder wrote about Warren Buffett. The actual quote from the book is life is like a snowball. The important thing is finding wet snow and a really long hill. What the quote gets used online is all you need is wet snow and a really long hill. The funny thing is that Warren Buffett, this is or the story is not about dividends. It's been co-opted, and we'll talk about that here in a second. But the book is really about money, relationships, reputation, knowledge, everything that can compound, not just money or air quote dividends. So here's the funny thing is Berkshire Hathaway, which where this snowball idea comes from, has only paid one dividend in 60 years. They paid a 10-cent dividend in 1967. And the actual quote, Buffett has joked through the years that he must have been in the bathroom when they declared the dividend because he's never declared one. The term is attributable origin. Nobody really knows for sure. Came into the internet around 2010, and the FIRE community, which is the uh, investment retire or not investment, it's the financially uh, independent retire early community. If you're not familiar with that, they've kind of adopted this dividend snowball idea, and I think it's a kind of a blend between the quote from the book and Dave Ramsey's snowball that he uses for debt. So the interesting thing is that Warren Buffett does not pay a dividend. He never has. He's associated with dividend snowball, but he's never paid a dividend. And a big part of that is because for 60 years he was able to allocate the capital and reinvest it at a better rate than he could if he was paying a dividend. Unfortunately, most CEOs are not Warren Buffett, and so that's why he's been able to do this, and that's why he's been able to get away with not paying a dividend all these years. So a dividend snowball actually has 3 engines running at the same time. So we have the reinvestment, uh, engine, we have the dividend growth engine, and we have our contributions. Our contributions at the beginning are frankly the biggest part of the dividend snowball, but the dividend growth and the reinvestment, as we will see here, will definitely have an impact uh, going forward. So, what most thumbnails, when you look at this on YouTube, leave out is the first 10 to 15 years, the biggest engine by far is the contributions, like I just said. The snowball itself isn't rolling yet. We're basically just pushing it up the hill. People quit at year 6 because they were promised a snowball and they get handed a shovel. So if we look at the math, so let's use some easy math here. If you start with $10,000 and you pay $500 a month, 3% yield growing at 6% a year, it's realistic. It's going to grow into a dividend payer. So 10 years in a row, you have to put in, we put in $70,000 after 10 years. The portfolio is 115,000, which is awesome. And the dividend income is $287 a month. So that's not a lot. That's a phone bill. Ten years, we've put in $70,000 and we've covered a phone bill. That's per month. So if you run it forward, If you look at that, we see that 20 at year 20, it's at $908 a month. Year 30, it's at almost $2,400 a month. And at year 40, it's almost $6,000 a month. This is real money. But it looks like it takes time. And so what I'm showing you is what I want to talk about. You look at year 40, $2.3 million from $250,000 in um, contributions. The snowball does ask it works, but it works on a time scale that nobody puts into a thumbnail. So if you're 45 and just found dividend investing, you need to know that on day 1, not year 12, is when you quit. So we don't want to quit. We want you to keep going. And let's look at some more math. So how long until it pays you $50,000 a year? So if you put in $500 a month at 37 years, you'll be able to have $50,000 a year. If you look at $1,000 a month in investing, it's 30 years. So as you go up the savings scale, what it buys us is time. It goes a lot faster because you're adding more and more to the snowball as it gets there. So $500 a month is a lot of money, right? And if you are starting later, then you have choices. You either have to increase the amount of money that you're investing, or you have to find better returns. And we'll talk about that here in just a minute. But the snowball has to run twice as far that people think just to get to what their goal is. So $50,000 a year in retirement may not sound like a lot, but if you're just living on the income from the dividends, you're not including stock appreciation or selling off part of your portfolio to help fund that too. So these are all rules that we have to think about and keep in mind. So this is the math that a lot of people don't think about. They focus on one or the other, and they don't look at the combinations that we want to use to get the dividend snowball going. So what I did was I kind of used, with the help of AI, we used uh, combinations and kind of ran the math. So if you look at a 6% yield at 3% growth, so you're looking at a higher yield company like a Verizon, for example, and it's growing slower, which Verizon is. After year 10, the snowball starts to take over and your portfolio starts to grow faster. Uh, it- if you look at maybe a lower yield, 4.5%, and it's growing slower at 4.5, the snowball takes over in year 12. If you look at a lower yield even so, but it's growing faster, let's say 3% at 6% growth, you're looking at year 15. And likewise, if you're looking at 1.5 at a much faster growth, you're looking at year 21. So the high yield buys you time, the growth buys you future income. Neither one buys you more money. So that's one thing that we always need to keep in mind. And when you look at pictures of the snowball and you envision it, the biggest part of it is you want to understand that this takes time. It's patience. You have to put money into it to get it to grow. You have to try to find the right companies that in your portfolio to continue to make it grow. But we need to remember that the high yield buys you time and growth is going to buy you future income. So taxes, not a popular subject to talk about. That's something a lot of people focus on, but it is real and it is something you need to consider. The taxes, 18.1% have gone to taxes in the reinvestment loop. So you have to you have to consider what kind of taxable account you put it into and how much those taxes are going to make an impact on your income going forward. So look at the cost of the taxes depending on which account you choose and what your tax bracket is going to be. So in a Roth, the cost of the tax is going to be nothing. If you look at a taxable income with 23.8%, which is the top bracket, so awesome, you're making a lot of money, but you're also going to get taxed on that if you have it in a taxable account. So $423,000 of your retirement is going to come out in taxes. And so this is something that you want to carefully consider when you're starting your snowball and when you're starting to dividend invest. And what kind of account you want to put it in is very, very, very important. And it doesn't get talked a lot. It's not sexy. It doesn't get clicks, but it has a huge impact on your returns as well as the money that you can use in your retirement. And that's what we're talking about right now. So consider taxes, talk to an accountant, depending on where you are in your evolution, depending on how much money you're earning, how much money you think you're going to earn in the future, and where you are on the retirement scale. Definitely talk to a tax professional. I am not one. I will not give you tax advice. So I would definitely talk to a tax professional and get some guidance. If you have a retirement advisor, that's something that they can definitely help you with, and that could be a huge, huge benefit. So that's something I would definitely consider. So as we can see here from this little chart, taxes have a huge, huge impact on our returns and how much we could lose in our retirement. Okay, so let's tell a story. Let's talk about the best snowball that was ever will. I kind of teased that at the beginning. Let's talk about it now. So, in Buffett's own words, in his 2005 letter, he wrote, in August 1994, yes, 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we now own. The total cost was $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend received from Coke in 1994 was 75 million. By 2022, the dividend had increased to 704 million. So these are right from his 2025 letter, and that's amazing. In 2026, Greg Abel wrote that that investment is now up to $816 million. So that's how much money that they're making from this one investment. So let's put a number on how good that is. So if you look at that, the Coca-Cola investment has a 62.8% yield on cost. And for those of you unfamiliar with that, it basically you take the investment that you made when you originally made it compared to what you're getting a return on, and that's what your yield on cost is. So Berkshire gets 63 cents a year every year for every single dollar that it invested in Coca-Cola. So the 1.3 billion that it invested, it gets 63 cents on every dollar of that. So this position pays for itself about every 19 months forever. And they still own all of it. He's never sold a single share of it. So they own 1.3 million shares. It earns $816 million annually on the income, on the dividend. The market value is 27.9 million or 27.9 billion. And the dividend growth per year was 8% for 31 years. So this is the greatest documented dividend snowball in history. And now what's what happens when we put one more number next to it? It's still lost to an index fund. So as great as that investment was, Coca-Cola has annualized since 1993 9.03% a year. The S&P 500 over that same period is 10.82% a year. So the best dividend snowball ever built, underperformed, doing nothing at all. So if you look at that, you might think, "Oh gosh, that's terrible. That is not something we really want to aspire to," right? Well, that's the wrong way to frame it. That's the wrong way to look at it. The fire community looks at the dividend snowball as a way to outperform the market. That is not the goal. That is not what they really should be selling or talking about. In my opinion, again, in my opinion, I think it's better to look at how is this going to fund your lifestyle. If our goal was to outperform the market, we wouldn't be buying companies like Coca-Cola, Procter and Gamble, Johnson and Johnson. That's not what those companies are designed to do. Those companies are designed to give us a return on our investment via a combination of dividends, share repurchases, and share appreciation. Because the share appreciation for those companies is going to be far, far lower than a company like Google will be, albeit it's a dividend payer now. The share return is far less of a percentage of a return for Coca-Cola than it is for Google. And at some point, that will switch. And that will be how you would look at that investment. So the thing that I want you to consider is even though the dividend snowball lost to the S&P 500 by the air quote greatest one ever, it still was a fantastic investment. And $816 million a year is nothing to sneeze at. Not that we're going to achieve that, because I don't know how many of us watching have 1.3 billion laying around to throw at a company like a Coca-Cola back in 1994. So that being said, this is still a very viable investment strategy and something you definitely want to consider thinking about. So, what could break a dividend snowball? What could really set this the wrong way? So the easiest way to look at it is if the companies that we're investing in stop paying a dividend. So the next few slides are going to show some examples. So GE Electric or GE, this is one of the more famous dividend invest paying companies. It paid a dividend every quarter since 1899. In February of 2009, the first earthquake happened, and they cut the dividend. So it was the first cut since 1938. In 2017, the Dow removed the company from the Dow in June of 18, and they cut a dividend 50%. And in October of 2018, they cut it again, and the market cap went from 270 billion to 65 billion. Here's a little number that should make you shaking your shoes a little bit. If you owned 1,000 shares of GE in 2008, you would have earned a little over $1,200 in dividends. By 2019, that would have been $40 in dividends. So that's a 96.8% income cut for doing nothing wrong except holding the company. And we should be honest about this. One thing to realize is GE has actually split off two of its other uh, segments of the business, GE Vernova and GE Aerospace. I think it has a different name, but those have both done very, very well, and it has definitely propped up the returns of GE since then. So that has actually helped generate some good returns for GE investors if they had held through that. But that's always a caveat if they had held. You at Walgreens. This is the whole problem with holding and holding forever and not really understanding the business and understanding how cuts could happen or are coming. So Walgreens, probably one of the more famous ones, they cut their dividend in 2024 by 48%. That's after 47 years of dividend increases. So it got removed from the dividend aristocrats. In January of 2025, they suspended the dividend entirely, and then in August 25, the company was taken private and delisted, which means that if you were a shareholder, you would have lost everything. So it's not as bad as a bankruptcy, but you would have lost, many dollars on the pennies on a dollar you would have held, and you would have lost the dividend. So this is why understanding the businesses and what drives the dividend is so critically important. Realty Income. This is a company that I've been very bullish on, and we talked about last week. And I do own the company, so fair disclosure. The last two dividend increases the company issued were 5 hundredths of a cent, so kind of peanuts. The company the way they do it is they do one real dividend increase a year, usually in December or January, and the other some of the other ones throughout the year are just token bumps to keep the streak alive. They advertise that they pay a dividend monthly, and so not every single month is going to be a huge return on the dividend. And so that's one thing to always keep in mind when you're looking at different companies is kind of digging into the numbers. And that's not something that I've talked about, and so that's my bad. But this is definitely something that you want to keep in mind when you're looking at it. The dividend doesn't, or the dividend snowball, if you will, doesn't always go straight up and to the right. So the stock hasn't done so great over the last few years. So it's a return at about 3% a year, which is not awesome over the last couple of years. And but the dividends have kept growing, so you've been able to earn a 4 to 5% return on the dividends, even though the share price has not done so great in the market. In large part, that's been because of REITs and interest rates. So the thing about the stock market is sometimes you can get a dislocation in the quality of the business versus the price, and that's what we've been seeing. So if you look at the AFFO or the adjusted funds from operations, which is the cash flow for a REIT, that has compounded quite nicely at 53% from 2016 to 2026. But the stock market price, the multiple has gone from 23.4 to 14.5. If you look at the headline numbers for Realty Income, they look pretty good. 98 98.9% occupancy renewal rate, pretty awesome. 75% AFFO payout ratio. Again, fantastic. Credit rating A minus, so awesome. And a data beta, which is 0.73, which means the company is not very volatile compared to the normal one of the S&P 500. So here's a list of some of the dividend aristocrats that have been removed over the last few years. So we see companies like Bank of America, General Electric, we talked about, Ross, AT&T, VF Corp, Walgreens, and 3M most recently. So even though these companies had very long streaks, a lot of them, it doesn't mean that a dividend streak could come to an end. And that's the one thing that could really disrupt a snowball. So if we look at this chart here, we can see that companies that cut their dividend lost money for 53 years. This is the real lesson, and it isn't buy dividends, it's avoid the cut. So Warren Buffett and Charlie Munger have both said throughout the years that rule number one is don't lose money, and rule number two is don't forget about rule number one. Avoiding stupidity, avoiding losses is far more important than finding the next Amazon. And a lot of people in the stock market focus more on the finding the next Amazon than they do on avoiding the cuts. And if you're in the market for a very long time, you want to avoid bad investments. You want to avoid losing money. You want to avoid dividend cuts. And so that's why looking at payout ratios, earnings ratios, payout free cash flow payout ratios, understanding the debt load of the business, understanding the business and what's driving the dividend. If you can understand, get your head around all of those things, then you'll have a better chance of having safer dividends. Nothing's going to prevent the black swans, but that will give you a better than even chance of staying above board. So we've talked about all kinds of negative things and we've talked about how the snowball done poorly. Let's talk about a dividend done right. So four fixes that survive the math. So if you do these four things, this is how you can build a great dividend snowball. So one, own growers, not the highest yield. So own companies that are growing a dividend faster, not necessarily the highest yield. Match the yield to your phase. So remember, high yield buys time, growth buys future income. So which one you need depends on where you are. If you're 25, you want growth. If you are 65, you want high yield. So just kind of think about that. And as you get older, you can kind of reverse the split, if you will. And that's kind of how I think about it. Number three, put it in a Roth. Depending on where you are with your income and how much you can contribute, there are limits how much you can contribute in a Roth. But if you have a choice, put it in a Roth. And if you max out your Roth, that's awesome. That's great news. And then you have some other options. Again, talk to an accountant. There might be some other ways for you to continue to have a tax deferred or a tax benefited dividend investment account and fund it before you optimize it. So don't worry about the companies you're going to buy so much at first. Worry more about having the right account picked, i.e., a Roth. Make sure you're saving enough to put money into the snowball because remember at the beginning, that is going to be what's going to drive it the vast majority. And as the snowball starts to pick up steam, then the dividends will start to kick in and help you out with that. And then third, worry about what kinds of investments you're going to choose, whether you're using SCHD or other dividend in index funds or whether you want to pick individual stocks, make that your kind of your third choice. So we want to remember that when we're looking at snowballs, there's two different jobs. There's two phases or two different jobs. The first phase is the accumulation phase. So this is the total return. We want to look at putting as much money into the snowball as we possibly can upfront to build that snowball up quicker. We want to use the shovel, not the hill. Then the distribution is we're looking at how are we, you know, I guess, reaping the benefits of our shoveling. So this is the income stability, how much you need in cash and how much you're going to need in share appreciation and selling of your shares. So if you want to judge the distribution phase, holding to an accumulation phase yardstick is how you end up thinking a 5% yielder with a 0.73 beta is broken. So you want to remember that we have two phases and we have two different jobs and think about where you are in those phases and in those jobs and try to allocate your capital accordingly. So with that, So, I guess the verdict, should you do it? Yeah, absolutely. Dividend snowball is actually absolutely beneficial. It's something I'm trying to build myself, and it's definitely something you want to do. The timeline, again, understand that it is a timeline. There's no way to do this quickly. The only thing that's gonna really benefit you is the compounding time of money and the more money that you can put in. So the first 15 years or so of this snowball is gonna be you pushing, and then after that, it's going to be the snowball going down the hill. Fund it, then shelter it, then pick. So put enough money away, put it in the right account, and then find the companies that are gonna work best for you, and then your next job is making sure that you avoid any cuts. So the snowball definitely works, you just need to think about it honestly, have an honest timeline, and understand what the jobs are and where you are in the timeline of those jobs. So with that, we will go ahead and wrap up our conversation about the dividend snowballs. I hope you enjoyed this. If you are new to Dividend School, please check out my YouTube channel at dividend.school. That's the handle. And you can see all these videos uploaded on Tuesdays.